So I suppose it's incumbent upon you, Rhydian, really, because you're not taking any balance sheet risk at the moment. I suppose I have to sort of kick it off with you, really. Why is it you shouldn't have to take balance sheet? And let me say why we've asked the question in the way we have. We framed it. Marketing lenders do not need to take balance sheet risk. And I think what we're trying to get at there is, if you're just trying to sell to institutions, you could accept you're dealing with sophisticated individuals who could caveat emptor principle. They know what they're up to, and you don't need to prove that you've got a model that puts skin in the game. But if you're marketing to retail, but also just to advisory, I imagine as well. A lot of people think, well, you should really put skin in the game because they know that you're there alongside them. So surely that you should be doing that. Brilliant.
Well, I think the argument that was articulated earlier by Samir, which is to say that the transparency is the skin in the game, it's intellectual. So I appreciate it's kind of might not land on the street, but if you carry it through, I think it's very coherent. And we mustn't forget that ultimately, or initially, let's say, perhaps not ultimately, initially, these businesses are exchanges, and no one would ask the London Stock Exchange to produce its own pounds and put into every equity deal. So I think it's a very sound basis on which to proceed. And if you think of yourself as a marketplace, then you focus on other things, which is transparency, technology, performance. So I really don't think there is a need for a marketplace lender to put its own money in. Now, it might choose to do so, and I'm happy to talk, why I can see there's...
And we'll come back to that, yeah.
There's merit. But I do think that the argument of the marketplace lending being a clean exchange is very compelling.
Okay, well, that sounds very convincing.
It does. Is this on?
That's
Good.
on.
Okay. And I understand it, and I think the marketplace lending model has evolved from the peer-to-peer kind of initial model, which is very much kind of match, single transaction, single on both sides, and it's evolved from that part to kind of a more centralized model where the platform effectively does a range of jobs on behalf of the ultimate lender, effectively. Mm-hmm. I guess my question is, again, to start off, it is a philosophical question, which is, as lenders, whether you're a direct lender like OnDeck or hybrid lender like OnDeck, or you're a marketplace lender, at the end of the day...
Yeah, because it's just important to say, you have...
We have both. Our model is roughly 40% marketplace, 60% on balance sheet.
Yeah.
But we started out as balance sheet lender, as a direct lender, and we've evolved that over the last few years. But I think it goes to this core thing. What are you as a business? You're a lender, and the key thing as a lender, I suppose the core competence is assessing risk. And so I guess the issue I have with marketplace lending, the issue I throw out there, is if your job is assessing risk, but you're doing that on behalf of somebody else, then it doesn't feel like you're effectively aligned. You're subcontracting or outsourcing the key component that will lead to eventual success to somebody else who's doing the job on your behalf. So I think philosophically, I think it's a slightly different kind of.
Yeah, really, that does. I mean, there is some truth to that. Surely there must be. Which is, you could be as transparent as you want to be, but if effectively you aren't the principal who isn't going to take their capital on the line, you might just go, oh well, it will just be more expensive. We'll put interest rates up, and you'll just have to live with more defaults. And just that's the way it is.
Well, I mean, I think that the point about the audience that you're trying to attract is quite important. It's a subtlety that perhaps is worth teasing out, which is that, because I'm not sure that they're assessors of risk, I think arguably they're kind of categorizers of risk. So long as they get the and there's a slight distinction, which is to say that, you're predicting what the likely risk is going to be, which is slightly different from assessing, which is arguably beginning to stand behind. But I think if you believe, or you're trying to design a business where the investors are extremely active, extremely informed, then I think that points to being able to just categorize the risk and allow the investors to make the assessment themselves. Very much a pure marketplace model. That might trend towards more of an institutional investor base. We at RateSetter have taken other views, which I'm very happy to go into. But I can see that it will have an impact on the audience. One just advantage for marketplace lenders not drifting into or not being required to put any capital up, is that they can scale much, much quicker. I mean, the banking industry does become kind of constrained by capital during cycles. And I think, as Niall just pointed out, that's actually a very poor outcome, because as the cycle goes through, you suddenly get capital constrained, and therefore lending has to stop. Whereas if you just put the capital requirement effectively onto the crowd, you make it very, very dispersed.
Well, I mean,
therefore it's very, very robust across cycles.
I mean, that's got to be a key thing, isn't it? Because, let's be honest, why did the alternative finance world, or the whole alternative lending world, come into place? Because a lot of the banks weren't doing what they're supposed to do. And they were doing it for perfectly rational reasons. Everybody has a go at them, but actually they were doing it perfectly rationally, because they were being told to, quite often with the regulators and Basel III regulators and all sorts of stuff. They're behaving rationally. And that pro-cyclicality is dangerous for the economy. It's horribly dangerous for the economy. And Niall was talking a bit about it earlier on. One of the reasons the Eurozone's not done so well in terms of its economic growth in the last few years is very bank dependent. And because the banks have basically had lots of rules based.
They're a function of their capital base.
Exactly. Therefore, it's just not good for the economy. So actually, the marketplace lenders can at least channel funding where funding is needed. So that's good for SMEs. So surely good.
Don't disagree. I think it is good for SMEs to have, range of actors outside of banks. So I'm not disagreeing with the notion that there is a better model than the banking model. I think, at the moment what we're exploring is there's a hybrid alternative lending model, and then there's a pure marketplace model. And I think, both of those will continue to evolve. They may get actually closer rather than diverge. So I don't have that issue in terms of is there a better model of the banks. I think the key problem that happened with the banks during the crisis, lots of questions on originate to distribute, etc. I think they just took their eye off the ball of the end customer.
Yeah, completely.
That's the fundamental problem. Yeah. So again, one of the things I would question over the marketplace model is if you run it out, we know these businesses need to scale. They need to originate. Samir talked earlier about $100 billion annually. Why is that? Because you don't have the economics there, so you have to originate a huge amount. What happens when you do that is, in a pure marketplace model, an exchange model, you start to focus on the transaction as opposed to on the customer. And I suppose our experience over nearly 10 years of lending through economic cycles is that the customer is not, that small business owner in our case, it's not a commodity. It's not they come in different shapes and sizes. So I think it's dangerous to think about the transaction as a homogeneous transaction that you can just kind of run through, because each individual loan, each individual customer is very different. And so spending the time to get to know them, what you're selling is not the loan or the transaction, it's the relationship over the number of years with that customer.
Really, that's a very interesting point. I mean, I don't know if you've seen The Big Short yet.
No, I keep missing it.
Yeah, you should do. Yeah, absolutely. It's worth watching Margot Robbie alone, just explaining what an asset-backed security is. The crucial thing, which they succeeded a Big Short, where a bunch of hedge fund guys go down to, I think, a convention in Florida, and they run into a bunch of mortgage brokers, or allegedly mortgage brokers, who basically just effectively describe what Rob's described. Transactional model, which is there are loads of people, because they've got to get to scale, they just pump them out.
But you could argue the investment bank did pump them out, and very few of them now exist. Merrill Lynch is gone, Lehman's gone, the ones that were pumping it out, actually.
Yeah, but yeah, absolutely. And the whole mortgage-backed security thing is still there. So that structure's not gone. But I suppose it's the agency effect what I'm trying to get at, which is what you're sort of saying, which is if you're focused on transaction, effectively you walk into the agency trap problem, which is just because if you've got to scale to 100 billion, frankly, what you really care about is, I'm not saying you don't care about transparency. I'm not saying that for 1 minute. But what you fundamentally care about is revenue. You care about getting bums on seats, revenue through door, and that's a transaction-based thing. And transparency works fine with that, but effectively it's all about increasing the revenue.
Yeah, I mean, one thing that we've done at RateSetter is that we have voluntarily reduced the upfront fees on our loans and taken more service fee.
Right,
fee
okay, that's
to return
interesting.
the loan.
Yeah.
And we've done this partly to say to people that actually we are trying to become a business that has a long-term interest in the performance of the loans,
Right,
as
okay.
much as the kind of transaction clip on the way through.
Yes.
And I mean, that seems to be, and we did it just before we raised money, so it seems like we were shooting ourselves in the foot because our revenue has kind of gone very static, even though our volumes have gone right up. But we're trying to build a kind of long-term revenue base that's in aligned with both our investors and
So
our
you
borrowers.
would accept that there is some agency risk and that agency risk can be mitigated by the incentive structure?
Yes, I do. I mean, running the business, I feel so attached to it that I it's difficult for me to sort of see that because it's natural for us to sort of believe, oh, well, we're equity holders and therefore we have a long-term interest in the business. But I can see at a macro level, yes, there is an agency risk.
Okay,
We're doing things actually within our business, in our P&L, to avoid that conflict.
Let's just go as Rob suggested, let's go back to basics and see, would we, if we tried to build the perfect structure, would it look like a marketplace lender or would it look like something else? So let me work backwards. So let me start question number one. Question number one is, in order to get to scale, you've got to put in both institutional and retail money, okay? Arguably. But in order to get to scale, you've got to put in quite a bit of retail money, yeah? Now, the problem with a lot of retail money is, I think it's fair to say that with Funding Circle, they've got quite a sophisticated private retail audience, and it's a good, very loyal audience, does very well. RateSetter and Zopa, there've been debate about this, but because you're dealing with consumer loans, you're a broader audience, and you don't speak the language of saving, you speak the language of investing. But I think it's fair to say that you probably try to go to a very broad audience, yeah? People who effectively are looking for a home for their £20,000, £50,000, and might only want one month returns, for instance, which is what you offer. Now, if you talk to that crowd, I would argue, don't really understand risk in the same way that a Funding Circle, maybe experienced entrepreneur who's putting money to work over that they've run their own business, they're happy to put it for 4 or 5 years, they know they're lady small businesses, it's a Nesta reports that said they're quite a sophisticated crowd. I'm not saying yours aren't sophisticated, but you get my drift.
They're the same people, actually.
Yeah, okay, fair enough. But I'm not entirely sure that a lot of that crowd really do understand risk. I don't really think they get it.
I mean, I think it's about what product you choose to give to the world, and there's quite a lot of divergence going on in marketplace lending. I mean, which I think is a subject that was touched upon last year and is developing more and more as the business grows. So at RateSetter, we've proudly decided to introduce something called a provision fund, which seeks to mitigate or absorb losses and indeed move losses through the cycle. So it's a sort of counter-cyclical buffer,
yeah.
And that's our choice, and that is going to result probably in a different audience in the long run to the pure marketplace lenders, and that's just our choice. And we see ourselves as a marketplace not because of the qualities that we're talking about or debating here, but because we allow interest rates to float. That's our view of what a market is. So we will have our different views on things. We actually, as a business, as shareholders, lend on our platform. We do that not because it's intrinsic to our model, but just because I think it's quite an attractive yield for our shareholder capital. And indeed, actually, our provision fund was lending in our marketplace, and we disclosed that, and it actually became unpopular with our users. And so we withdrew that. I think we might return.
Why did you do it?
I think there's a logic to it, to be honest. I mean, we listened to our customers, so we immediately withdrew. A bit like, it seems like politicians have changed their tune, and whether they'll come back to the subject. But I mean, the logic was that the one thing that the provision fund is long of is cash and liquidity. In that we are getting a clearer and clearer idea of its liability profile.
Yeah.
So therefore, it follows that it is becoming and it's important we put an investment policy in process for the provision fund, and it's therefore long liquidity, and we felt it was very sensible for it to enjoy some of the returns in our market rather than the other options, which would be to look for institutions to fund those loans temporarily, or indeed banks, which is conversations we've already had. And we looked at the term sheets that banks came with, and we thought that that's actually quite expensive, and that would we prefer for the economics to sit within the provision fund, all on a very kind of balanced basis, maybe up to 10%, 15%, so that was the thinking, and we disclosed it, and our customers didn't like it, and I understand why they had reservations, because they felt it was a bit of a circular reference. And so we listened, and we sort of changed the policy. But I wanted to kind of have an opportunity to say that, because I didn't want it to be like a sort of unspoken thing. I noticed it wasn't on Sameer's headlines, and I wanted to explain the logic for it, which is to say, the provision fund, we now are beginning to see its liability profile, and it does not all happen all at once. And it's interesting that the crowd, if you like, did not get comfort from the ecosystem taking balance sheet risk itself.
Talking of change of plans, also with you as well, you started off with the pure balance sheet model. You ended up using market. Why did you change your model?
I wouldn't say we changed it. We've evolved it and grown it.
Yeah.
As the business has evolved over the last 10 years. So obviously OnDeck now is at some scale. We've lent over $4 billion of our own effectively capital since inception, close to 1.9 billion last year. In the US, Australia, Canada, so a number of countries. And I think in doing that, what we've learned is that, through that economic cycle, you need oxygen, you need capital to be able to lend. So obviously originating customers is very tough. It's the hardest job that there is. But once you originate them, once you find them, once you've figured out what is the product they want, you need to be able to fund that. So our evolution as a business has gone from obviously being venture capital funded and equity funded, which is highly non-cost effective, to having long-term bank funding arrangements in place, warehouse facilities in place. We did a securitization last year, also, which is quite a large securitization, first time from small business loans of this kind of tenor were securitized in the US. And then we evolved into marketplace as well, because our overall thinking is security of supply, diversity of supply, first and foremost, to be able to kind of balance and manage those various sources of finance as the economic cycle matures.
I was just going to say that one thing I think that is quite positive about marketplace lending, peer-to-peer lending, or non-balance sheet lending is that, and we are we're trying to look at this very carefully at RateSetter, is that banks, which are obviously very balance sheet heavy, is because they give a guarantee. That's what they look to give. That is their sort of customer promise, if you like. That is their product. They give a guarantee. And that necessarily is very, very balance sheet heavy with regard to liquidity requirements or capital requirements. And I think what we're trying to do at RateSetter and other platforms, I'm sure looking at other different ways of doing it, is actually we are huddling some of that together. So, for example, the provision fund. But at the same time, what we're really doing is putting a lot of those kind of capital and liquidity risks ultimately back to the investor. So you kind of disperse them across a huge amount of people, which is quite efficient, I would argue, as opposed to trying to huddle them all centrally like a bank does and say, we'll stand behind all of this. Because in the end, that is either tends to be too safe, or in really bad times, not safe enough, and then you've broken your promise. So we're deliberately trying to say that we're not going to take on large capital requirements, and the return for which is that we're not giving a guarantee. And we think that's actually a system that has a chance of giving great value to customers.
One very last question. If you started off now, you're established, would you start off with a hybrid model, or would you still start off with a balance sheet, with the original balance sheet model?
I think, to start off as a lender, you need to learn the business of lending. So, this is why starting off as a balance sheet lender is difficult to do. You need to raise that equity, you need the performance, it's a chicken and egg situation. I think, I think over the long term, in terms of the healthiness of these platforms need ultimately to be sustainable. And I think some of the leading platforms, the RateSetters, the funding circles, etc., will get to that scale where they'll become sustainable businesses. I think that's easier to do with a balance sheet model. because you've got a number of jobs to do, and there's a set of costs associated with that. I've talked about originating, I've talked about underwriting, servicing the customer, the risk of refunds, the risk of fraud, etc. You've got to assume all of that. So you need to be able to also charge a reasonable amount to be able to cover that cost and ultimately make.
So possibly, if this, what you're sort of saying is, if you're a big scale player, you can use transparency to your advantage, so you can see data and be more accurate. But actually, if you're a smaller player now, balance sheet may be a better way to go, actually, because in a sense, you don't have to scale advantages. This is a chicken and egg situation. You're not a scale player. That you might learn better credit risk dynamics that way from a balance sheet approach.
Yeah, I think that's a good summary. We don't know where kind of the future will go from here, but I suspect whether it's either from a regulatory point of view, or indeed, I think as Rhydian has just outlined in terms of some of the steps they've taken in their business, I think you'll see some of the kind of pure play platforms move more perhaps towards taking on some of that risk on their balance sheet or through their business model. Also just from an economic point of view, because they're doing the hard job of originating those customers, underwriting them, so they might as well keep some more of the economics.
Rhydian, very quick question to you. I mean, I can see your argument makes sense at your scale now, but to go back to that earlier point, if you were starting again, if you were one of the smaller platforms in the audience really starting again, might not the attraction of a balance sheet approach make some sense now when they're fighting against people like you, who are big scale players? You could use transparency and scale to your advantage, yeah? You can offer that robustness. And actually, for a newer platform, it's a bit difficult, and maybe you should do the balance sheet approach.
Yeah, I mean, I guess it's hard to get a track record, and maybe it's easier just to get going yourself. But I would ask people to keep the faith, and if you are transparent, and it's amazing that investors will come. Yeah, they will come. So I would keep the faith.
Keep the faith.